Welcome back to the channel, guys. I saw a lot of questions in the Discord and certainly in my comments as well around the differences between ETFs, trusts, and OEICs. So I do want to cover this off. OEICs is probably not one that many people are familiar with. Certainly the comparison of the ETFs and trusts is important. And kind of navigating the modern investment landscape kind of requires understanding of these vehicles that hold your assets. And as I said, there are three titans of pooled investments. There's exchange-traded funds, investment trusts, and traditional mutual funds. Defining just what OEICs are early on. So traditional mutual funds are most commonly structured as OEICs, or open-ended investment companies, or unit trusts. So unlike ETFs or investment trusts, which trade on stock exchanges, OEICs are typically unlisted. So they're not on a stock exchange. You buy and sell units directly from the fund provider as a single daily calculated price. So I just want to talk quickly about the market landscape. So exchange traded funds have witnessed explosive growth since their inception, becoming almost the default choice for passive index tracking investment. Meanwhile, traditional mutual funds, OEICs, still hold the vast majority of the global retirement wealth due to their historical dominance. And in contrast, investment trust closed-ended funds represent a niche but highly resilient sector optimized for active management, illiquid asset exposure, and constant income generation. So if we look at it from a market size perspective, global ETPs or ETFs are 11.5 trillion. So they dominate the passive investment sector with massive scale and high liquidity. We then have the global mutual funds. OEIC AUM is around 40 trillion. So the traditional titan of pooled investments widely used in standard pensions. And then we have global investment trusts at around $350 billion, a specialized sector focused on active management, alternatives, and income. And we can see how big that gap is between trusts and ETPs. So I'm going to talk through the structural mechanics of each. So I think it's important to understand this. So the most profound kind of difference between these vehicles is the capital structure. So ETFs are typically open-ended, meaning shares are created and destroyed continuously based on demand on the exchange. Investment trusts are closed-ended, public companies with a fixed number of shares trading on an exchange. And OEICs are open-ended, but are bought directly from the provider, not on an exchange. So let's break out each of these ETFs and ETPs. So I kind of want to explain ETPs first because I don't know how many people know about this. So I think it's important for me to cover. So while commonly called ETFs, exchange traded funds, this is an umbrella. So it includes ETCs, exchange traded commodities like physical gold, ETNs, exchange traded notes, which are debt instruments, and they're all broadly classified as ETPs or exchange traded products. Okay. Open-ended listed, so authorized participants create or redeem shares directly with the sponsor to meet demand, keeping price aligned with NAV. Management style, predominantly passive, designed to strictly track an underlying index via algorithms. And there's transparency and costs, so highly transparent with daily holding disclosure, general featured, much lower expense ratios. So here the creation redemption is us as investors. We put our bid into the market makers, work with the fund sponsors, and then you get this bid and sell sort of price spread. If we look at funds and OEICs, open-ended, unlisted, units are created, cancelled directly by the fund manager when you buy and sell. They do not trade on stock exchanges typically. Management style is historically active. Managers must hold physical cash buffers within the fund to meet potential daily redemption from investors. And then you've got the transparency and costs, so no bid offer spread on an exchange. Holdings typically disclosed monthly or quarterly. So here you're directly dealing with the fund manager and the transactions once a day as a single NAV price. If we start to then finally look at investment trusts, which are closed-ended, listed, fixed pool of shares because managers don't face forced selling from redemptions. Capital is completely locked in for the long-term bets. Management style, predominantly active, fund managers can confidently invest in highly illiquid assets like property, private equity, and infrastructure. When we talk about gearing or leverage, legally allowed to borrow money to buy more assets, this amplifies both potential gains and losses. So it's almost like a secondary market, new buyer, exchange, current owner, actual asset pools untouched by daily trading. Okay, let's look at popular examples just to give people a flavor. Now, none of these are investment advice or buying advice. I just want to throw this in here just to help people understand common examples of what these are. So if we look at ETPs, there's the SPDR S&P 500 ETF SPY. The granddaddy of ETFs almost tracks the S&P 500 index, providing highly liquid, low-cost exposure to the largest US companies. Now, some of these listings are US-based, so just bear with me on that one. It's just the broad audience. There's also the Invesco QQQ Trust, QQQ, which tracks the NASDAQ 100 index, heavily weighted towards major global technology giants, known for its high growth. Again, this is passive. And then we've got the iShares Physical Gold, IGLN, an exchange-traded commodity that tracks the spot price of gold by holding physical gold bars in a secured vault. Then if we look at OEIC stalwarts, some of these names will probably not be familiar to a lot of you. Some of you may be aware of them. So if we look at Fundsmith Equity, one of the most popular active managed UK OEICs, focused on concentrated portfolio of high quality global businesses. We then have Vanguard's Life Strategy, which is passive and multiple. So a massively popular series of open-ended funds provide automation, fixed weight diversification across equities and bonds. And we also then have Fidelity's Special Situations, a classic active unit trust that seeks out overlooked companies, demonstrating the traditional mutual fund approach. And then we've got the trusts, so the aristocrats. So one of the most popular ones, and I invested in this back in the day, was Scottish Mortgage, SMT, a highly profile growth trust that uses its closed-end structure to invest heavily in unlisted private companies alongside public equities. Then another very popular one, City of London, which I owned, I think probably over 10 years ago now. Don't have it in my portfolio now, but famous for its dividend hero status. It has utilized its revenue reserves to increase its dividend payout every year for over 50 years. And then we've also got another popular one, which again I owned probably about 10, 15 years ago, don't own anymore, which is F&C Investment Trust. The world's oldest collective investment scheme, launched in 1868, provides a high diversified global portfolio and utilizes moderate gearing. Okay, so if we start talking about sort of price dynamics, premiums and discounts, because ETFs utilize a creation redemption mechanism, their share price rarely deviates from the net asset value of their underlying holdings. Investment trusts trading via fixed supply and fluctuating demand frequently trade at a premium, above NAV, or discount below NAV. So you almost hear a lot of people talk about discount to NAV and why they want to buy discount to NAV. And this is why investment trusts give them that opportunity. OEICs never trade at a premium or discount, but process an exactly NAV once per day. And so if we categorize this a bit, the discount with trust, so buying an investment trust at a discount means acquiring a $1 worth of assets for 90 cents. If sentiment improves and the discount narrows, investors benefit from a double whammy of an asset growth and a structured price correction. If we look at it from an OEIC's daily NAV strike, traditional funds do not trade live. They use forward pricing, where you place an order and receive the single net asset value NAV price calculated at the end of the trading day, and zero intraday control. If we look at ETFs live transparency, ETF investors bypass the stress of premium discount volatility while retaining live intraday trading. The continuous arbitrage mechanism ensures you always pay the true transparent market value of the underlying basket. Another element to this is income generation and dividend smoothing. So for income-seeking investors, investment trusts possess a unique superpower. So by law, they can retain up to 15% of their income they receive from the portfolio each year. These revenue reserves act as a financial shock absorber, allowing trusts to artificially boost dividend payments to investors during economic downturns. ETFs and traditional funds conversely must distribute all received income, leading to unavoidable dividend cuts during recessions. And I've just tried to give a hypothetical scenario illustrating market shock in year 2, and you can see how trust can maintain its dividend streak using stored cash reserves, while ETFs payouts drop symmetrically with the broader market yields. So if we start to look at this from a pros, cons, and risk perspective, if we start off with exchange traded products, The pros are extremely low ongoing management fees, typically highly liquid, tradable, instantly during market hours, high transparency of underlying holdings, price tracks NAV extremely closely. The cons are it typically struggles to outperform the index, excluding specialized active ETFs. It's forced to buy high, sell low during index rebalancing. And I think this is one of the biggest criticisms of ETPs is that rebalancing if they're tracking against an index. And then you've got potentially broker trading fees that apply per transaction. From a key risk perspective, tracking error, failure to perfectly mirror the index, counterparty risk, specifically for synthetic ETFs or ETNs, where a bank guarantees the return. If we start to look at traditional funds now, OEICs, the pros are transact at exact net asset value, no premiums to discounts, easy to set up, automate, regular monthly investments without dealing fees, massive variety of active and passive strategies available. The cons are forward pricing. You don't know the exact price when you place the trade. Cash drag, managers must hold cash for redemption, lowering potential returns. And then there can be platform fees that can compound over time. The biggest key risk here is managerial risk. So active managers may underperform the benchmark. And then you've got liquidity gates. In crisis, managers can freeze withdrawals if underlying assets are hard to sell. Finally, investment trusts. So closed-ended structure allows pure investment in illiquid, high-return assets. Dividend smoothing provides high reliability income streams. Potential to buy top-tier assets at a structured discount. Structural gearing can boost returns in bull markets. However, the cons, complex pricing. You can lose money even if the underlying assets go up if the discount widens. Generally higher management and performance fees, and subject to bid-offer spreads and broker fees. Key risks are discount widening, so market sentiment turning against the trust, and leverage risk, where borrowing amplifies losses significantly during market downturns. Okay, I kind of want to try and put this into a matrix as best I can for each of these three, and we'll start off with the primary objective. For ETFs and ETPs, it's low-cost market tracking beta. For funds, it's market outperformance or asset allocation. And for trusts, it's market outperformance alpha. In terms of the trading mechanisms, for ETFs, it's intraday on exchange. For funds, it's once daily via provider, forward pricing. And trusts, it's intraday on exchange as well. From a transparency perspective, ETPs are fully transparent. Holdings disclosed daily. Funds, less frequent disclosure, often monthly, quarterly. Trusts, it's less frequent disclosure, often monthly and quarterly. If we look at liquidity now, ETPs, highly liquid, standard equities, bonds, commodities. Funds must hold mostly liquid assets for daily redemptions, and trusts can hold illiquid assets like private equity and real estate. When we talk about pricing risk now, ETPs, minimal, trades extremely close to NAV. Funds, none, always transacts at exact NAV. And trusts, significant, subject to market sentiment, causing premiums and discounts. If we talk about income reliability now, typically for ETPs, variable strictly mirrors underlying yields. If we look at funds, it's variable, must distribute all received income. And if we look at trusts, highly stable, protected, and smoothed by historical revenue reserves. So, how do we summarize and conclude this? There's no single investment vehicle that is objectively better than others. They're distinct tools designed for different jobs ultimately. So, choosing ETPs when your goal is low cost, broader diversified passive market exposure, they are the ultimate tool for core portfolio building and capturing the overall market's returns efficiently. Now, I have obviously bucketed other things in there, like certain ETPs I know that do cover calls and high income strategies, which, are not following an index. So just bear that in mind. If we talk about OEICs, when you want to automate monthly investments without incurring dealing charges, or when you prefer a traditional active management operating without the volatility of the premiums and the discounts, and then choosing trust when seeking high stable income, or when targeting specialized illiquid assets like infrastructure, private equity, or commercial property, when closed-end capital lock-in is a distinct advantage. So there you go, guys. Hopefully that's a good summary of the different types of funds and ETPs and OEICs, and you understand the comparisons between them. Don't forget to like the video if you found it useful. And as always, hit the subscribe button if you want to learn more. You'll get notified every time I release a new video. It really helps the channel as well. And if you haven't already, join us in the Discord. If you put requests in there, I'll do my best to get to them. And you can join and talk to like-minded people. Okay, guys, I will catch you on the next one.